Okay, let's unpack this. We often talk about AI in business innovation through the lens of, efficiency.
Right, cutting costs, chatbots.
Exactly. But the true driver of AI adoption, particularly in the complex world of finance, isn't efficiency. It's the radical recalibration of risk itself.
Mm.
So today we're diving into what is really a fundamental schism. You have this 20th century banking model built entirely on tangible physical assets.
Land, buildings, things you can touch.
Right. And that's clashing with a rapidly emerging 21st century economy that's powered by, well, intangible value, by data flows and digital behavior.
And that's the key.
Our mission, then, is to explore why alternative credit scoring is emerging as let's call it the killer app for AI, especially in markets like Nepal. And maybe more importantly, why the inability of legacy banks to embrace this is an existential threat to them.
If we connect this to the bigger picture, you have to understand this is so much more than a technical upgrade. It's an economic power shift. Well, the battle for the next decade of business lending. It won't be fought over who has the lowest interest rate. It will be fought over data supremacy.
Data supremacy.
The institution that can accurately and quickly price risk using these alternative data streams is going to dominate. This isn't some distant trend. This is an economic force brewing right now.
To really get a handle on the disruption, I think we first have to appreciate just how rigid the problem is. Our source material gives a perfect illustration.
Yeah, the anecdote about the merchant.
Exactly. Let's set the scene with this story of a third-generation merchant in Assam in Kathmandu.
The really thriving spice business.
A thriving business. And crucially, her whole operation has modernized. Her inventory is digital, her revenue. It flows robustly through mobile payment platforms. PhonePe, ESO.
So there's a clear digital trail, a rich, measurable tapestry of transactions.
Proof of consistent cash flow. Reliable revenue. So she should be a prime candidate for a loan to expand, right?
So you'd think so. She's financially active, successful, digitally visible.
But when she goes to a commercial bank for a working capital loan, maybe to buy more inventory, the first question the loan officer asks isn't about her profit margins, not about her PhonePe volume.
It's always about you two.
Physical collateral, specifically a land title.
And of course, she doesn't have one. Maybe she rents her shop. Maybe the family property is tied up. But this doesn't matter. The loan is denied.
And she's denied not because her business is fundamentally risky.
No, but because she's invisible to the bank's traditional 20th century system.
She's profitable, but she just doesn't own the right kind of fixed asset. This scenario, it perfectly defines what the analysis calls the collateral prison.
And that phrase, collateral prison, is so accurate. Because Nepal's lending framework isn't just a preference for land. It's a deeply entrenched institutional and regulatory prison.
A prison, right?
For decades, all the policies, from the Nepal Rashtra Bank all the way down, were built around land and buildings. I mean, it offered stability when information was scarce. But now, it's the primary bottleneck to the whole economy.
And here's where that systemic exclusion really comes into play. This model, it systematically excludes the most dynamic, high-growth parts of the modern economy.
The asset-light SME.
Exactly. The asset-light small and medium enterprise.
We should probably pause on that. These SMEs are the engine of growth everywhere. But in a modern economy, their value isn't physical. Think about a software development firm.
Right. Their value is their IP, their code.
Their code, the human capital of their engineers. Or, say, a digital marketing agency with recurring client contracts. Their assets are intangible. They can't be valued on a bank's traditional checklist.
So the system just declares them unbankable.
Regardless of how profitable they are. And this spirals into a really profound social paradox. This system disproportionately disenfranchises groups that are vital for development. Female entrepreneurs, for example, are statistically less likely to hold formal property titles.
And young innovators, too. The ones building the next generation of business, they don't have inherited land.
Right. And the core issue, as the analysis powerfully states, isn't that the risk of lending to them is inherently higher. It's simply unpriced by the traditional model. The banks are using a broken lens.
So if the old system sees a void, the new system, the one powered by AI, promises to illuminate it.
Yes.
Alternative credit scoring doesn't eliminate risk, but it does illuminate and quantify it with just unprecedented precision.
It completely changes the contract. It works on the premise that a person's digital life, their verifiable financial behavior, is a far more accurate and dynamic predictor of repayment than a static land deed
It turns the unbankable.
into a calculable market segment. It makes them visible.
So what's the mechanism here? How does the AI actually achieve this?
Well, the AI credit engine completely transforms the input data. Instead of relying on, 2 or 3 static metrics collateral, an old balance sheet,
Right.
the model ingests a vast, rich mosaic of alternative data points in real time. We can really break this down into 3 critical categories. The first is transactional data. This is the lifeblood of the business. It looks at the frequency, the volume, the consistency of payments through digital wallets like Kultiu or Isoa.
Revenue from platforms like Daraz, supplier payments.
Exactly. It's a dynamic income statement available instantly. Instead of a balance sheet from 6 months ago, you get real-time cash flow verification.
Got it. What's the second category?
The second goes deeper, behavioral and network data. This moves beyond just the numbers. The AI analyzes the business's entire digital footprint.
You mean like customer reviews?
Customer reviews, social media professionalism, even the financial health of their key suppliers and customers, their whole ecosystem. Are the people they do business with financially healthy? That's a huge risk signal.
I can see why banks find this so complicated. But the third category is the one I think often gets overlooked, but it's incredibly potent.
Utility and bill payment data.
Yes.
It's arguably the most potent predictor of financial discipline. Consistent, on-time payment of basic utilities, electricity, internet, phone bills. It shows a real commitment to responsibility.
It's a proxy for reliability.
A huge one. A business that prioritizes keeping the lights on is showing a fundamental reliability that's highly correlated with loan repayment.
So the AI's job isn't just to gather all this data, it's to find the hidden correlations that a human loan officer would just never spot.
That is the entire innovation. The AI moves the assessment from a simple correlation, like do you own land, yes or no, to a complex probability score.
Like with the restaurant owner example.
Exactly. The algorithm finds a pattern. A restaurant that maintains a 4.5-star average on FoodMandu, combined with paying utilities within 5 days. It finds that business has a 98% probability of repaying a small, unsecured loan.
That's a phenomenal level of granularity. It moves risk assessment from a binary yes or no decision
To a sophisticated probability-based score, and that enables risk-adjusted lending. You can price the risk accurately. A startup with a 90% repayment probability might get a slightly higher rate. A proven SME with a 98% score gets a premium rate.
whereas the traditional model can only offer one product.
A large collateralized loan, that's it.
But if we're relying on these complex algorithms, how do we know they aren't just, creating a new form of digital redlining? How do we stop the AI from becoming a black box?
That's a critical question, and it's why regulatory oversight is so vital. The argument for AI, though, is that while it can be biased if you train it with biased data, the current system is inherently biased against anyone without a property title.
That's a very good point.
The AI, when it's properly monitored and regulated for fairness, can be programmed to ignore biased historical proxies like gender or caste and focus only on pure behavioral metrics. It can actually reduce systemic bias.
So we don't have to guess if this works. We've seen it play out elsewhere.
The lesson from India is stark. Fintechs like LendingCart built billion-dollar loan books by leveraging the India stack.
Which is their digital public infrastructure.
Right. Digital identity, unified payments, all these APIs that allow them to instantly verify identity, check transaction history, and underwrite unsecured loans in minutes.
So India created the rails for data to flow, and the fintechs built the engines.
Precisely. And Nepal has already laid the tracks with its digital payment infrastructure. The big strategic question is, who's going to build the engine here?
Which leads us right to this conflict we're seeing unfold. Why are nimble fintechs winning this race, and not the incumbent banks?
Yep.
I mean, the banks have the capital, the customers, the trust. Why are they trailing?
It's fundamentally a conflict of DNA. Incumbent banks are legacy risk management institutions. Their digital transformation is often just superficial. A mobile app slapped on top of an inflexible, expensive core banking system.
So their internal plumbing is just not built for it.
It's totally incapable of integrating and processing the complex, real-time data streams you need for this kind of credit scoring. The technology barrier is high, but the cultural barrier,
That's the real wall.
it's immense. Bank hierarchies are incentivized by loss aversion. A risk officer's career is safer denying 100 good, digitally underwritten loans than approving one loan based on some black box algorithm that later defaults.
The whole mindset trusts a tangible land deed over an abstract algorithm.
It actively punishes the necessary experimentation you need to adopt AI. Meanwhile, fintechs operate on completely different principles.
They're tech companies first.
Exactly. A different risk tolerance, a lean cost structure, no overhead from physical branches. This lets them profitably service the smaller loan sizes that banks just ignore. Their whole talent pool thinks in probability and scalability.
So they're not trying to squeeze AI into a rigid banking framework.
They're building a new framework around the AI.
And this is why you call alternative credit scoring the Trojan horse strategy. It's not just a product upgrade.
It's the entire business model redesigned. By using AI to solve the hardest problem in finance pricing risk for the information poor, they unlock a massive blue ocean market that the incumbents have just dismissed. The loan is the beachhead.
And once they acquire that SME with a superior, fast, unsecured loan, they have the loyalty. They own the financial relationship.
Absolutely. From that beachhead, they cross-sell everything else. Payroll, payments, treasury management. They conquer the entire relationship just by being the first to actually see the customer for what their business is worth.
So looking at the strategic outlook, the analysis suggests the future here isn't polite coexistence, it's substitution. The market is bifurcating.
Right. There are two main paths. The first is what we can call the path of painful adaptation. A few forward-thinking banks will try to compete. They'll acquire fintechs, build expensive parallel AI divisions, but it's fraught with cultural organ rejection. The legacy culture just suffocates the AI culture,
And the majority of banks fall further behind.
leaving them with a shrinking pool of large collateral-rich clients.
And the second path, the one the source material deems more probable.
The path of disruptive substitution. Well-funded, AI-native neobanks, they just bypass the incumbent system entirely. Their cost of lending and speed will be so superior that they can simply outcompete the incumbents for that high-growth SME segment.
The hard truth here seems to be that the primary threat to commercial banks isn't technological obsolescence, it's strategic irrelevance.
That's it exactly. They won't cease to exist, but they'll become niche utility services, managing the static wealth of the rich and servicing large conglomerates.
While the engine of real economic growth.
The vibrant SME ecosystem will be entirely owned by these new AI-powered financiers. The incumbents will be left perfecting the art of collateral-based lending while the market has already moved on.
This puts an immense responsibility on regulators, specifically the Nepal Rostra Bank. Regulatory inertia, even though it's designed for stability, can unintentionally suffocate the innovation you need to finance the future.
It's the single greatest catalyst for this disruption, actually. The critical intervention needed is very specific. It's the creation of a clearly defined regulatory sandbox for AI-based credit scoring.
And let's just clarify what a regulatory sandbox is for anyone listening.
Sure, it's essentially a protected environment. The regulators set up clear, secure boundaries where new technologies like AI credit scoring without collateral can be tested with real customers under safe limits.
So the regulator can gather data on how it performs.
Exactly. Data on model performance, privacy, algorithmic fairness, all before granting wider approval. Without this proactive pathway, the regulations just end up protecting incumbents from competition, which hurts the whole economy.
So what does this all mean for you? The true power of AI in fintech is its ability to quantify risk in these previously unanalyzable segments like asset-light SMEs. It transforms them from unbankable into a profitable new customer class. It's all about market creation through better data.
Which raises an important question for you to mull over. If traditional commercial banks are left holding illiquid titles to yesterday's assets, to land and buildings, and the new economy is driven entirely by financial rails built on dynamic digital data flows, what happens to the perceived or the actual market value of those physical assets when they are no longer the primary, essential measure of financial viability?
It makes you wonder if the things we value today will be valued tomorrow. Thank you for joining us for this deep dive.
A pleasure, as always.